3 digits. That is the entire distance between someone who gets approved for a mortgage and someone who doesn't. 3 digits between a job offer and a polite rejection letter. 3 digits standing between you and the apartment you applied for last week. Most Americans check their credit score the way they check the weather. It feels like a permanent feature of the landscape. Like it has always been there, polished and standardized by generations of careful banking practice. It hasn't. The universal credit score, the 3-digit number that now decides who gets a loan, a rental, or even a job, was invented in 1989. The same year, a British computer scientist at a Swiss laboratory sketched out a system for linking documents across computer networks. One became the gatekeeper of American financial life. The other became the World Wide Web. The reason you have never heard them mentioned in the same breath is that one of them is still marketed as if it were ancient. If you have ever assumed your credit score was built up and refined over the course of the 20th century, tell us in the comments what you thought it was before watching this. Walk into any bank in America and ask for a loan. Within seconds, a number between 300 and 850 will appear on a screen somewhere. That number will determine the interest rate you are offered, the credit limit you receive, and in many cases, whether you are approved at all. It feels inevitable. It feels institutional. It feels like the kind of tool that could only have emerged slowly, the way interest rates or checking accounts emerged, refined over decades until they became invisible infrastructure. That instinct is wrong. The system most Americans interact with through their FICO score did not exist before 1989. There were credit reports before 1989. There were credit bureaus. There were lenders making decisions about who was trustworthy and who was not. But the specific act of compressing a borrower's life into a single 3-digit number, distributed universally across all 3 major credit bureaus, that act is younger than most of the people watching this right now. The World Wide Web turned 37 years old in 2026. The FICO score turned 37 years old in 2026. They share a birthday. One of them has a birthday cake and a documentary. The other has a stranglehold on the financial lives of most American adults. Understanding why the credit score feels ancient, even though it is not, requires going back to the world that existed before it. A world that was not more accurate. A world that was not more fair, but a world in which the decisions were made by people, not by formulas, and the consequences of those decisions were kept in folders, not in databases. In 1841, a New York merchant named Lewis Tappan founded something called the Mercantile Agency. It was the first commercial credit rating operation in the United States, and its purpose was simple. Tappan and his agents would gather information on businessmen across the country and sell that information to other merchants who were deciding whether to extend credit. The agency's files contained everything its investigators could find: court records, debt histories, rumors. If you were a merchant in 1850 and you wanted to know whether a supplier in Chicago could be trusted to deliver goods on credit, you paid the Mercantile Agency for an answer. By the 1860s, the agency had developed an early alphanumeric rating system, but the letters and numbers were just shorthand for what the agents actually thought about the borrower. The reports often contained rumors about a person's character, personal information about race and ethnicity, notes about the neighborhood they lived in. The judgments were subjective, local, and frequently wrong, but they were also human. This model survived, with modifications, for more than a century. In 1899, a man named Guy Wolford and his brother Cater founded the Retail Credit Company in Atlanta. The company would eventually be renamed Equifax, and it would become one of the 3 bureaus that still control most American credit data. But in its early decades, retail credit did not behave like a modern data company. It behaved like an investigative agency. Retail credit hired field investigators whose job was to physically visit applicants. They knocked on doors. They interviewed neighbors. They filed reports that included subjective observations about a person's morality, their lifestyle, and what the investigator thought of their general character. These reports were then sold to local lenders, who used them to decide whether to approve a loan. For most of the 20th century, this is how credit worked in America. Department stores had credit managers who evaluated borrowers one at a time. Local banks had relationships with local bureaus. The decision rested on a folder, a conversation, and a gut feeling. The system was slow, it was inconsistent, and, as the civil rights movement would later document in detail, it was openly used as a tool of racial discrimination. Retail credit's field investigators were eventually the subject of civil rights complaints and Federal Trade Commission scrutiny in the 1960s. The old system was broken. Nobody disputed that. The question was what would replace it. In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac founded a small consulting firm in San Rafael, California. Both had ties to California's research and engineering community. Both believed that lending decisions could be made using statistical models instead of human judgment. Their idea was straightforward. Take a large data set of past borrowers. Identify the patterns that separated the ones who repaid from the ones who defaulted. Build a formula that could score new applicants based on those patterns. The math was not controversial. The pitch was. In 1958, Fair and Isaac walked into the offices of 50 large American lenders and tried to sell them on the concept. 49 said no. The 50th, a company called American Investments, said yes. It would be 5 more years before another lender signed on. The universal credit score was still more than 3 decades away. For the next 31 years, Fair Isaac made its living the way most consulting firms do. They built custom scoring models for individual retailers. They ran analyses. They published papers. They waited. The product worked. The industry did not want it. Lenders had spent generations building their own internal systems, and the idea of replacing those systems with a black box built by 2 men in Northern California struck most executives as somewhere between unnecessary and threatening. By the mid-1980s, the credit bureaus themselves were beginning to feel the pressure. According to FICO's own corporate history, the firm developed an early consumer credit score called Prescore in partnership with the bureaus, but the relationship was tense. The bureaus saw Fair Isaac as a competitor, not a partner. Fair Isaac's scores, if widely adopted, would make the bureau's raw data files less central to the lending decision. The fight over who would own the scoring layer of American credit dragged on for years. It was not resolved until 1989, when Fair Isaac launched the universal FICO score. The score was distributed through all 3 major credit bureaus. It was built on the same statistical principles the founders had been refining since the late 1950s. But this time, the bureaus signed on. By 1991, Equifax, Experian, and TransUnion were all offering the score to lenders. By 1995, Fannie Mae and Freddie Mac had voluntarily adopted it for the conforming mortgage market. The number that had been rejected by 49 out of 50 lenders in 1958 had, 37 years later, become the default tool of the American credit system. The score worked. The default rates it predicted were real. But the speed at which it conquered the industry was not a measure of how good the math was. It was a measure of how badly the old system had failed. Lenders were desperate for something that looked objective, that could be defended in court, and that did not require a field investigator to walk into a neighborhood and ask the neighbors what they thought. The FICO score was designed for one purpose. It was built to predict the likelihood that a borrower would default on a consumer credit obligation. That is what the algorithm does. It weighs payment history, credit utilization, length of credit history, new credit, and the mix of credit types. It produces a number. The number was supposed to answer one question: should this person get a credit card? It did not stay in its cage. Within a decade of the 1989 launch, The FICO score was being used by mortgage lenders, auto lenders, and credit card companies across the country. By the mid-2000s, it had moved into territory its creators had never intended. Landlords began using it to screen tenants. Auto insurance companies in most states began using credit-based insurance scores to set premiums. Utility companies began demanding deposits from applicants with low scores. Cell phone carriers started pulling credit reports on people signing up for service plans. And then employers got involved. According to a 2012 survey by the policy organization Demos, roughly 1 in 4 unemployed Americans reported that a potential employer had requested a credit check as part of the hiring process. 1 in 10 said they had been told they would not be hired because of something in their credit report. The score had been built to predict whether someone would repay a loan. It was now being used to predict whether someone was worth employing. This was not a designed outcome. Nobody at Fair Isaac in 1989 intended for a 3-digit number to influence whether someone could rent an apartment or get a callback from a hiring manager. The expansion happened because the score was convenient. It was cheap, it was already there, and it had a veneer of objectivity that made it difficult to challenge in a country still uncomfortable with the explicitly subjective judgments the old system had made. For most of the score's history, there was no organized opposition. The number was too embedded, too invisible, too widely accepted to challenge at any single point of use. But in the last decade, a slow regulatory counter-movement has begun. As of early 2026, 11 U.S. states have banned or severely restricted the use of credit checks by employers. California was among the first. Colorado, Hawaii, Illinois, Maryland, and others followed. On December 19, 2025, New York Governor Kathy Hochul signed legislation making New York the 11th state to restrict the practice. That law takes effect April 18, 2026. The bans are narrow. They target one specific use case: employers pulling credit reports on job applicants. They do not touch lending, housing, or insurance. But they represent something significant. For the first time in the score's 37-year history, state legislatures have concluded that the number, in at least one major domain, is being used in ways that cannot be defended. The civil rights arguments against employer credit checks are well documented. Studies have shown that credit reports correlate with race, with income, and with the financial shocks that follow unemployment or medical emergencies. Using them to screen job applicants effectively punishes people for being poor at the exact moment they are trying to escape poverty. The new state laws reflect an emerging consensus that the score, whatever its value in lending decisions, has no legitimate role in deciding who gets hired. This is the part of the story that is still being written. The score has not been dismantled. It has not been replaced. But the legal infrastructure around it is being rebuilt, one state at a time, in response to a public that is only now beginning to understand how widely the number has been deployed. 3 digits. That is the entire distance between approval and denial in modern American life. And for most of the country's history, that distance was filled with people: credit managers in department stores, field investigators knocking on doors, local bureau clerks pulling folders and making judgments about character, neighborhood, and reputation. Those judgments were subjective, inconsistent, and frequently discriminatory. They were also, in a way the modern system rarely is, accountable to a human being you could look in the eye. Then, in 1956, 2 men in California started trying to replace those judgments with math. It took them 33 years to convince an industry that did not want to be convinced. The score they finally launched in 1989 was not the first consumer credit score. It was the first one the industry accepted universally. And it was launched the same year Tim Berners-Lee proposed a system for linking documents across computer networks. The World Wide Web grew into something its creator did not fully anticipate. The FICO score did too. One became a platform for almost everything humans do online. The other became a gatekeeper for almost everything humans do financially. Both are younger than the people who use them most, and both are still being shaped in real time by decisions being made in courtrooms and state houses that nobody had heard of a decade ago. The credit score is not an ancient institution. It is a 37-year-old algorithm that inherited an old job and has been quietly expanding the terms of that job ever since. What surprised you most about this story? Tell us in the comments. And if you enjoy discovering the real origins behind familiar things, leave a like and subscribe to the Origin Portal.